studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
At first glance, the tax on split income rules can feel overwhelming. Many tax practitioners encounter TOSI for the first time and wonder why something that sounds simple becomes so complicated in practice. The reason is that TOSI is not a single rule. It is actually a network of interconnected rules, tests, exceptions, age requirements, ownership requirements, and business-related conditions that must often be considered together. Think of TOSI as a maze. The goal is to reach the point where a dividend qualifies for normal dividend tax treatment. However, along the way, there are many different paths, decision points, and potential exceptions that must be evaluated. Some rules focus on the age of the shareholder. Others focus on the relationship between the shareholder and the business. Some rules examine capital contributions, while others look at ownership percentages, active involvement in the business, or whether the return being received is considered reasonable. As practitioners work through a TOSI analysis, they often encounter concepts such as excluded business rules, excluded shares rules, reasonable return rules, family relationship considerations, and various ownership tests. Each rule may lead to a different conclusion depending on the facts of the situation. This is why TOSI requires a structured approach. Problems often arise not because the rules are impossible to understand, but because a particular rule, condition, or exception was overlooked during the review. The good news is that successful TOSI analysis is not about memorizing every detail of the legislation. Instead, it is about following a consistent process, asking the right questions, and systematically working through the available exceptions. The key takeaway from this slide is that TOSI feels complicated because multiple rules interact with one another. The challenge is not finding a single answer. The challenge is navigating through the maze and identifying the rule or exception that applies to the specific facts of the case. Once you accept that TOSI is a complex set of rules, the next step is learning how to navigate that complexity in a structured way. This slide provides a practical roadmap that tax practitioners can use when analyzing dividends paid to family members or other related shareholders. The process begins when a shareholder receives a dividend. Rather than jumping immediately into technical legislation, start by gathering the key facts about the individual and their relationship to the corporation. One of the first questions is age. Different TOSI rules can apply depending on whether the shareholder is under 18, between 18 and 24, or 25 and older. Age is often an important starting point because certain exceptions are only available to specific age groups. Next, consider the shareholder's relationship to the business. Did they work in the business? Do they own shares directly? Did they invest capital into the corporation? Have they assumed financial risk by guaranteeing loans or exposing personal assets? These facts help determine whether there is a meaningful connection between the individual and the business. Once the facts have been gathered, the focus shifts to identifying possible exceptions. This is where practitioners begin evaluating concepts such as the excluded business test, the excluded shares test, the reasonable return test, and other available exceptions within the TOSI framework. If an exception is found and all conditions are satisfied, the dividend will generally receive normal dividend tax treatment. That is the desired outcome because it preserves the intended tax planning benefits. However, if no exception applies, or if the conditions of an exception are not fully met, the dividend may become subject to TOSI. In that case, the income can be taxed at the highest marginal personal tax rate, significantly increasing the tax cost. The most important lesson from this slide is that successful TOSI analysis is not about memorizing hundreds of detailed rules. Instead, it is about following a logical process, gathering the right facts, and identifying whether a valid exception exists. In many cases, the entire exercise can be viewed as a search for an exception that allows the dividend to escape the TOSI rules. One of the biggest mistakes people make when learning the TOSI rules is believing they need to memorize every piece of legislation, every exception, and every technical detail before they can analyze a dividend situation. That approach often leads to frustration, confusion, and missed issues. The beginner approach is usually rule-focused. The practitioner tries to remember age rules, ownership tests, family relationship rules, CRA guidance, reasonable return concepts, excluded business tests, excluded shares tests, and numerous legislative provisions all at the same time. Very quickly, the analysis becomes overwhelming. Experienced tax practitioners take a different approach. Instead of trying to memorize everything, they follow a consistent framework. The process begins by identifying who received the dividend. Once that is established, the next question is the age of the shareholder, because age can influence which TOSI rules and exceptions may apply. The practitioner then asks a more important question. What did the shareholder contribute to the business? Did they work in the company? Did they invest capital? Did they assume financial risk? Did they participate in management or decision-making activities? After understanding the facts, the practitioner looks for possible exceptions. Rather than reviewing every exception immediately, they focus on the exceptions most likely to apply based on the shareholder's circumstances. The next step is gathering evidence. This might include employment records, timesheets, investment documentation, loan guarantees, shareholder records, meeting minutes, or other supporting documents that demonstrate the shareholder's involvement in the business. Finally, everything is documented in the file. Good documentation is one of the strongest defenses if the dividend is ever reviewed by the Canada Revenue Agency. Notice that this approach is based on process rather than memory. By following a structured framework, the practitioner can work through even complex TOSI situations without becoming overwhelmed by the legislation. The key takeaway is simple. Successful TOSI analysis is about following a process, gathering evidence, and documenting conclusions. It is not about memorizing every rule in the Income Tax Act. The best practitioners rely on a framework, not memory alone.